Hey everyone, welcome back to Corporate Decoder, the place where we demystify the complex world of corporate finance and give you the real scoop. Today we're diving into Lennox International's June 30, 2020 interesting numbers in here that tell a story you won't want to miss. Alright, buckle up because we're about to unpack Lennox International's financial health. This report covers their second quarter and the first half of 2025, so it's a great snapshot of where they stand. First off, let's look at where the company stands in terms of its assets and liabilities as of the end of June 2025. Their total assets are $3.65 billion. That sounds like a lot, and it is. But it's important to see how that stacks up against last year. It's an increase from $3.47 billion at the end of 2024, which is generally a good sign, meaning the company has grown its holdings. One of the bigger numbers on the current asset side is accounts and notes receivable, which stands at $868 million. This is money that customers owe them, and it's up significantly from $661 million at the end of last year. This shows they are selling more, but it also means they need to make sure those customers pay up. Now let's flip over to the liability side. Total current liabilities, which are debts due within a year, are over $1.4 billion. That's a pretty big chunk. Interestingly, their accounts payable, which is money they owe to suppliers, has jumped up to $582 million from $490 million a year ago. This could mean they're buying more inventory to meet demand or perhaps stretching out their payments to suppliers. On the flip side, their total stockholders' equity is $900 million. This represents the owner's stake in the company. It's good to see this figure grow. It's up from $850 million at the end of 2024. Now let's move on to how the company is actually performing in terms of making money, their income statement. For the second quarter of 2025, Lennox reported net sales of $1.5 billion. That's a 3% increase from the same quarter last year. So business is growing, which is always a positive signal. Their gross profit, which is what's left after accounting for the direct costs of making their products, also saw a nice jump of 7% to $22 million. This indicates they are either selling their products at a better price or managing their production costs more efficiently, or a combination of both. Operating income, which is profit before interest and taxes, also went up by 11% to $354 million. This shows the core business is doing well, and the bottom line, their diluted earnings per share, a key measure of profitability for shareholders, came in at $7.82. This is up from $6.87 in the same period last year, which is a solid improvement. Looking at the first half of the year, things are also looking up. They've returned $82 million to shareholders through dividends and bought back almost $300 million of their own stock. This shows a commitment to returning value to investors. Let's break down the segments. Their Home Comfort Solutions business saw its net sales increase by 3% to over $1 billion. This segment is their bread and butter for residential heating and cooling. The profit for this segment jumped by a strong 12% to $255 million. This is great news for this key division. Their Building Climate Solutions segment, which deals with commercial heating and cooling and refrigeration, also showed growth. Net sales were up 5% to $491 million, and segment profit increased by 7% to $122 million. The corporate and other segment, which basically covers the overhead and central functions of the company, had a small loss of $24 million. This is pretty much in line with last year and is expected for these types of central costs. Now let's look at their physical assets. Property, plant and equipment net of depreciation is $825 million. This is up from $800 million at the end of last year, signaling ongoing investment in their facilities. They also have $220 million in goodwill on their books. Goodwill typically represents the excess paid over the fair value of net assets acquired in a business acquisition. The fact that this number hasn't changed means no major acquisitions happened in this period, which is worth noting. Let's talk about debt. Their total debt stands at $1.8 billion. This includes commercial paper, senior notes, and finance lease obligations. While the debt level is substantial, it's important to see how it compares to their ability to generate profit. They have about $49 million in cash and cash equivalents. This might seem low compared to their debt, but they also have significant borrowing capacity under their credit facilities. They mentioned that this cash, along with future earnings and borrowing capacity, is enough to cover their needs, including upcoming debt maturities. A key detail is how they sell their products. For Home Comfort Solutions, direct sales to installers make up about 74% of revenue, and sales to distributors are the rest. In building climate solutions, it's about 80% equipment sales and the rest from services. This distribution strategy is crucial for reaching their customers. The company also spent around $14.5 million on stock-based compensation in the first half of the year. This is how they reward employees with company stock or stock options. It's a common practice and has increased slightly from last year. Going back to the share repurchases, in the second quarter alone, they bought back over 371,000 shares. This can boost earnings per share by reducing the number of outstanding shares. Their effective tax rate is around 19.4%. This is quite stable, and the slight decrease suggests they might be benefiting more from operations in lower tax jurisdictions. Their debt to total capital ratio is 57%. This means that 57% of their funding comes from debt. This is a moderately leveraged company. Their credit ratings from Moody's and Standard & Poor's are Bar 2 and BBB respectively. These are considered investment grade ratings, which is good. It means the credit agencies view them as relatively safe borrowers and they're not likely to default on their debts. Overall, Lennox International seems to be on a solid growth trajectory, with both their residential and commercial segments performing well. Their increased sales and profits at the operating level show a healthy business. The company is also actively returning capital to shareholders through dividends and share buybacks, demonstrating confidence in their future. However, some points to keep an eye on are the increasing accounts receivable, which means they need to closely manage customer payments, and the growing accounts payable, which could indicate some cash flow pressure or simply a strategic choice. Their debt level at 57% of capital is moderate but not insignificant. The upcoming maturity of $300 million in senior notes in August 2025 will be an interesting event to watch. How they manage this debt will be key. The company is also navigating inflationary pressures and tariffs impacting their cost of goods sold, but they seem to be effectively passing those costs on to customers through price increases, preserving their gross margins, which is a positive sign of pricing power. So what's the verdict? Lennox International is showing strong operational performance with clear growth in its key business areas. They appear to be managing costs well and returning value to shareholders. The main considerations for investors would be monitoring their debt management, especially with those August notes maturing, and keeping an eye on how those rising receivables and payables play out. It's a company that's growing and seems to have a handle on its day-to-day operations and strategic financial management. Alright, that's a breakdown of Lennox International's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.